Hello and welcome to LiveSquawk's Market Talk on Thursday, the 18th of December, 2025. On today's episode, we'll be previewing the ECB Interest Rate Announcement due at 13:15 GMT, 14:15 Central European Time. We'll also take a quick look at the Bank of England and the Bank of Japan as they have a rate announcements over the next hours and day, really, for both those central banks. Helping us prepare for the announcement today, I'm joined by Guenter Grimm, market analyst, strategist, and former bank trader of 25 plus years. He traded the FX, fixed income, macro, and quant, and is now founder of trader platform GGMA. Alongside Guenter, LiveSquawk's European editor Eric Culp, another veteran of the central bank scene. Welcome to you both and Merry Christmas.
Hello.
Hi, guys. Happy holidays.
Hi, Harry. Thanks for having me. Happy holidays as well.
Always worthwhile. Now the niceties are out of the way, a quick disclaimer. The content provided on this channel are for informational and educational purposes only. We are not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. Okay, thank you for that. And right, before I bring you guys in, we'll have a quick overview of today's announcement. This is a preview from Rabobank's Bas Geffen. Says, we do not see any reason for the ECB to change its policy at this month's meeting, neither does the market. Another hold will probably cement the market's view that the cutting cycle is over, but we do not expect Lagarde to explicitly confirm this. She will probably repeat her good place analogy, adding that ECB will stay vigilant to both upside and downside risks. Also, on our website, you can find Eric Culp, our European editor's preview of today's release or today's announcement, titled ECB to deliver Christmas hold, policy likely to stay on current path. And just note, he says, will the next move be up? As we'll get into that and discuss that as well. But Eric, what are your initial thoughts on today's meeting?
Yeah, I think it's going to be one of those explanatory meetings. This policy's been, what's this? This will be the third or fourth straight hold, I think. Third, I think. And, everybody kind of believes that that's where it's going to stay. You got people talking that they could be at this level through next year, and then the next move will be up. So there's talk of maybe slightly higher growth estimates, but that's not going to change anything, I don't think. And inflation looks right in their sweet spot. I mean, I think they're snuggled up nice and comfortable in their good place for at least the winter and probably into the next summer.
Yeah, fair point. Guenter, what do you make of today's decision?
Yeah, I agree with Eric. It's going to be maybe rather not boring, but unexciting, but maybe a few points. The language regarding the rate path going forward. Schnabel made this comment where she said she was comfortable with the market pricing in some sort of rate hike chance. So I'm sure she will be asked regarding that topic, and her answer then will be quite interesting if she protests against the minuscule rate hike, which is priced in for 2026, but there's more priced in further beyond. So I would watch out for that language.
Okay, but on the whole, generally speaking, she's not really going to want to shoot herself in the foot, really, and create noise around an event that really shouldn't create any kind of headline, I guess.
But that's never stopped her before.
This is true. Right, so let's look at this hike talk at the moment. Is it simply a case like of where we're at? I mean, I don't think, you said we're in a sweet spot for inflation, Eric. Based on that, I don't understand where this hike talk is coming from, because, like you say, we're not expecting runaway growth next year, which would potentially create some inflation. And then we're looking. So is it going to be exported or imported rather into the euro area? Where's this hike talk coming from, and why are we talking about hikes so soon after we've just paused effectively?
Well, I'm wondering if this is coming from the thought that Germany's spending is going to drive growth not only in Germany but in the Eurozone in general. I mean, there's a lot about what the cabinet approved 50 billion in purchases. That's a lot of money, right? This is just for uniforms and tanks and stuff like that. There's supposed to be a lot more coming. We're talking up to $1 trillion euros. I mean, or more. That's crazy money, right? Sure, it's over the next 10 to 12 years, but as soon as that money starts get dumped in an economy, it's going to spur growth, right? And that means scarcity, and that means inflation. And once growth starts kicking off, which everybody expects, I think 2027 is the better year for the first hike. At least looking at what growth expectations are. OECD has Eurozone growth next year at 1.2. They dropped that from, they expect 1.3 for this year. And they did raise their estimate from September, 0.2 percentage points. Yeah, we also don't know what's going to happen with Ukraine. Right.
Yeah.
And I think that's that's a shadow hanging all over this. Is it the rearmament of Europe going to happen even that much quicker, depending on what the decisions are in Brussels today and tomorrow, and how capitals are reacting to this, and what the United States is going to do? I think there's a lot in there. But I really think the German spending is part of what the concern is amongst economists about what the next rate move will be.
Okay, cool. Guenter, anything that you want to add to that?
Yeah, absolutely. I think Eric is spot on. I would argue also that maybe the real neutral rate should be above zero. So at the moment, we have 2% inflation and 2% nominal policy rate. So the real rate is at zero. I would argue that it should be maybe closer to 1%. So all these estimates are fraud. So this is really with high uncertainty, this guess I'm making here. But in a normal economy which grows steadily and probably potential growth in Europe is lower than, for example, in the US. So let's put it at 1% real growth rate. You add an inflation target of 2%-ish, plus or minus, and there may be some liquidity premium or uncertainty premium. It should be a bit higher than the policy rate, should be higher than 2%. And maybe that's what the market is pricing in there as well. I also noted regarding Eric's point regarding fiscal stimulus that real rates implied by the bond market in the Eurozone are edging higher. In the chart pack, you see that on the last page. So real rates in
Just trying
Germany,
to bring that up for you now so that we can have a quick look at that. So yeah, you carry on talking and I'll see if I can find it.
So they've risen from in the last year, basically from around 72 basis points to now 90, and so the trend is up, maybe partly due to the fiscal stimulus. And what I observed is that maybe real rates in the US are topping out at these levels. They are good percentage point higher than in the Eurozone. And I find these real interest rate developments quite interesting, especially if you want to make a call on currencies, in this case, the euro dollar. So if this trend were to persist, so higher real yields in the Eurozone, lower real yields in the US, that should be supportive for the euro versus the dollar.
Hang on a second. I think I found it. Here we are. Have I got it? Stop share. Yes, I've got it. There it is. So just a quick look at the document here then. So what page are we looking at? Was it the last page you said?
Please.
Okay. Let's see. So the euro dollar, yeah.
So on the left-hand side, we see the German real rate, the 10-year tenor, creeping higher, and in the US, the US rate is on the right-hand side, and maybe topping out. But it would make economic sense if the real yields in Germany or in the Eurozone would go higher, I think, on the back of more fiscal stimulus.
Good to see. Just looking at that. Yeah, go on. You were saying.
And in the US, I found Waller's comments very interesting yesterday, where he said the neutral rate in the US should be 50 to 100 basis points lower. Also, I think he had an interview yesterday with Trump, so maybe he's back in the race. From a policy perspective, I think he would be the ideal candidate because intellectually he is on board with further rate cuts. He makes the case. I think the bond market trusts him, and he's not such a wild card as, for example, Walsh or Hassett. So if Trump gets it, then he could choose Waller, and then he will push for lower rates.
I know we're not talking about the US, but I mean, there is the case that, the next Fed chair, I can't remember who said it, but they said the next Fed chair will be a dove, as an assertion.
I'm just bringing it up because it could also mean a higher euro dollar and then therefore a less aggressive ECB.
Yeah. I wanted to take a quick look at some of the recent comments we've seen from Fed officials here, and then just try and look at that with some of the things that we're seeing in the markets. So Lagarde said, my suspicion is we might upgrade the economy's outlook again in December. That leads back into Eric's point about maybe this is where that inflationary pressure may come from alongside the German investment. We've also had Villeroy speak, as seen today, there is really no reason to envisage a rate increase in the near future. That was the point I was making. I know there is some pushback within the council over the past few weeks against the assumption of a hike. But
right, what's the near future? Is that July? Is that the near future? Is next September the near future? Is December the near future? I mean, I know we're all dead in the long run, but the midterm can be anything, and just because somebody says midterm doesn't mean that, they're not people on that board already looking at the situation and say, yeah, we've cut enough here. We're good. And we're going to keep it here unless we really have to go lower. And, hey, look at the environment, right? It's only been 1 year of this president. It's crazy town, right? Everything, you don't know what's going to happen tomorrow because they need headlines. So, another shift in trade policy, who knows, pulling out of NATO, all that could change everything really quickly. But, given what we have today in the good place that the European Central Bank says it's in, midterm, I think, I don't think anything is going to happen next year.
So you think anything that does happen is external, is an external factor, is an international situation that is like to sway the heads of the European Central Bank as opposed to anything internal at the moment?
That seems to be the case. It looks like growth is starting to come up. Industrial production in October hit 2% annual rate, which some people are looking at and saying, okay, we're past the nadir here. We're actually maybe coming out of it. But there's still so much going on. Suez is about to open. That should cut prices. Right.
Well, what I would say is that China's stopped becoming a customer. This is a bank report I read, that they're now a competitor for Europe, the likes of Germany and so forth. So there's a dynamic there at play as well. They're not going to, maybe Germany doesn't get the kind of orders unless they're domestic, and I mean within the euro area itself, that they might have got before. Even car production is I wouldn't say in jeopardy, but the sort of dominance the European car makers and the German car makers have had is coming to an end in some respects, and it's getting a lot of competition out there from China with the electric, the EVs that we're seeing at the moment. So there are a few headwinds coming Europe's way, really, that like you say, leave a bit of something back on the sidelines in case you may need it down the line. And I was very surprised about this hike talk and how much traction it was getting, because I think, like you say, there's a long way between there and now in terms of situations.
A couple points. I think to say that the European car industry is not in danger, that might be going too far. I mean, the German Car Association called the latest adjustment out of Brussels, which basically eliminated the ban on internal combustion engines.
That's right. Yeah.
They're still allowed, but it's really still a small amount. The VDA, the German Car Association, called that decision disastrous. That's the quote, right? And they're going to still fight tooth and nail against it because they're worried about electrics and getting smoked, and they are getting kind of smoked right now. A friend of mine, he's a big gearhead, and he bought a BYD. They found their way. The Chinese suppliers found their way through the system by offering hybrids, right? And hybrids will still be part of the European plan, right? The straight electrics, they got 100% tariffed, but the other ones didn't, and now they're hitting the market. I think it's a danger there. I also think what's going to happen with oil if the U.S. starts shooting at people in Venezuela. That could kick off inflation for sure. I think right now, in the nice, quiet, slow time of December, right before Christmas, everything looks hunky dory. I think we all know this. Everybody's trying to position themselves ahead of the market, right? So if somebody sees a rate hike coming, they're like, okay, here's what we see on the horizon. It's way out there, but it's coming. So we can start positioning ourselves now. Look at what's going on midterm and even shorter term, and then be ready for what we think the eventualities will be.
Guenter, as a trader, as someone who looks at all this from a profit loss perspective, where are you at the moment with just the general trading environment and what you look at?
Yeah, I think I'm expecting more of a neutral outcome, maybe slightly hawkish with regard to the growth outlook, and maybe they edge up the inflation forecast. But I don't think they will indicate that a rate hike is near. So I agree with Eric. But then, of course, the question is, what's the medium long term? So they will probably be unclear about that and leave us a bit in the dark. So I'm looking more at the US, to be honest, at the moment, what's going on there with the numbers. We also have CPI numbers coming out with regard to the new Fed chair. I think that could be more the driver of euro-dollar going forward.
Okay, perfect. Right. We've kind of, so today's decision is to sum up, unchanged on today. We're looking, maybe Lagarde's put a foot in it and give us something that shouldn't really be an issue today, but really just around the language about the coming year and the prospects for the euro area in terms of growth, in terms of inflation and so forth from Lagarde. So that's out the way. We also have some other major central bank decisions we just quickly really want to look at. And one of them is going to be the Bank, which is up today at mid GMT. So we're looking at a 25 basis point cut to bring the rate down to 3.75%. Now that the budget is out the way, and we've seen what the incumbent government has for the economy, some say 125 basis point cut is not going to be enough. And actually, markets are maybe pricing in slightly more cuts into next year. But this is just a quick note from Deutsche Bank. Expected the Bank of England to deliver its final rate cut this year, taking the bank rate to a new cyclical low of 3.75%. Its sixth rate cut of the cycle. Indeed, disinflation progress for both prices and wages, combined with weaker growth, a disinflationary budget, a looser labour market, will likely be sufficient for a further dial down of restrictive policy, said the Frankfurt Bank's analyst in a note this week. So, Guenter, Bank of England, we've seen this coming for a while, I think, pretty much. Do you look from the Bank of England's perspective that we'll see further cuts into the new year? I think we discussed this on a previous episode. Your prospects for the UK aren't particularly high or stellar at the moment.
No, I think, as you said, the market has been waiting for this signal from yesterday's CPI report for a long time. Other indicators, real activity data, the labor market is deteriorating, all a bit softer. So maybe now is the time for the Bank of England to become a bit more dovish and more confident in the rate cutting cycle. Question is, where will it take us? Maybe towards 3%, or yeah, that would be my guess. So sterling actually reacted quite a bit yesterday, so softer on the back of the CPI numbers. So maybe sterling is a bit on the back foot for the time being, I'm fearing.
Yeah, fair enough. Just a quick note on that CPI, if anyone who may have missed it yesterday. It was on the softer side. Headline and core CPI undershot forecast, falling 3.2%. In the case of the headline CPI, it was from 3.6%. Goods inflation cooled sharply. Services eased as well. Food, tobacco, clothing prices were the main drivers to the downside surprise as well from yesterday's figures. That was on the back of labour market data that we said saw loosening the day before that on Tuesday. And really, there aren't many great signs. With last week, GDP contracted by 0.1%, really to slow momentum going into the final quarter of the year. So, you know, I hate to talk down my own economy, but we're not looking at a lot of great news out of the UK at the moment, and it's going to take something to really sort of turn that ship around in the near term, at least, and produce some activity, economic activity to be worthy of talking about, really. So again, as I said, markets pricing in more cuts for next year, at least 2 more cuts for 2026. I read as well. Right, and finally, we'll move on to the Bank of Japan. Bank of Japan interest rate decision will be out early tomorrow morning. It just always frustrates me. There's never an actual time. There's always sort of a range of times between 0300 GMT to 0500 GMT. We should get that out. And then the press conference is about 6:30 GMT. But Barclays on an expected 25 basis point hike to take it to 0.75%. They said it looks for the Bank of Japan to raise the policy rate at the December monetary policy meeting. That would represent the highest level in about 30 years. In a speech on the 1st of December, Governor Ueda made the market acutely aware of such a possibility. This appears to reflect successful coordination with Takaichi, the new PM administration, which is pursuing a high-pressure economy, but is also concerned about yen depreciation risk. And Guenter, just again, I know you're keeping eyes on the US predominantly, but obviously the yen plays a part for FX traders and also in the bond space as well. That's quite a significant and pivotal asset. Do you have any views on the Bank of Japan and what we're likely to see? Not really for tomorrow, but tomorrow if you can, and beyond.
Yeah. So here's what I think what they should do, and then I'll tell you what I think they will most likely do. So I think they should sound more hawkish going forward, because I think they're behind the curve. If they sound too dovish, they risk that the yen, which has been weakening again last couple of days, continues to weaken. You mentioned the government. The government doesn't give us the impression that they're interested in a strong yen. That's another problem. Also, their policies are more, so they're pro-growth, should be positive, but then also maybe inflationary. And if you then have a BOJ which is behind the curve and reluctant to hike in this environment, then the bond and the FX markets become nervous. So bonds come under pressure, yields higher at the long end, especially pricing in potentially higher inflation, and the currency weakens in lockstep. So I think they should sound more hawkish and try to get ahead of the curve. That would strengthen the yen a bit, and it would also flatten the yield curve and alleviate the risk that the Japanese bond market blows up at some stage. However, so tomorrow I think they will hike, but then they will probably convey a message. They will take their time again and wait and see what wages. I think wages are the most important factor in the decision process at the moment. If they would feel comfortable that wages would continue to rise at around 5% or so, then I think they would be comfortable in assuming that the wage inflation spiral will continue, and therefore they could hike. So I read an interesting piece, and usually they get the Tankang results with regard to the wage survey only in January, but at the moment it looks like they're trying to collect those data earlier. So maybe Ueda gives us a glimpse if he feels comfortable that the wage inflation will continue to be higher, and therefore they're comfortable in hiking. Maybe my hopes are too high, but
well, listen, we know they procrastinate. I mean, I think a rate hike tomorrow should be pretty much embedded, but again, it's the language and preparing the market for potentially more hikes to come. I mean, the Tankan report was fairly neutral and kept at levels, but it did show that inflation was still above target for the economy in the 1 year and 3 year horizon. I think even into the 5 year horizon as well. So ultimately, the short term disruptions from the tariff discussions with the US and everything else that basically impacted the economy from that are expected to be short-lived, according to Ueda's speech at the start of December, and therefore he's relatively confident, it would seem, that even one hike at the moment would not stop the economy from being or the monetary policy from remaining accommodative. So yes, be interesting. I think an interesting rate decision at the end of the week, at the end of the year, because I think now that once that's out of the way, ultimately, I think next week's going to be relatively quiet for markets as we go into the Christmas festivities. You can find previews for both the Bank of England and the Bank of Japan and the ECB today's decision up on the website as we close out this episode. If you want to take out a trial of the service, please go to LiveSquawk.com and go to the free trial. There's a week's free trial if you want to listen to what we do and see if it may help your trading day. And anyone who's missed the start of this can listen back on the social media platforms, X and LinkedIn, but also we'll put this out there on Spotify and some of the other podcast platforms if you want to go back and refer to anything we've said. Thank you to my two guests. Eric, thank you very much.
Thanks for having me. And again, Merry Christmas and Happy New Year.
And to you too. And Guenter, same to
thank
you.
you so much for having me, and also have a great time ahead.
Brilliant, guys. Lovely. Yes, I'd like to say to my audience, we've got another episode tomorrow of the weekly review, but then I think we're pretty much done for the holiday. So wishing everyone a Merry Christmas if you don't listen to any more. And if you do, I'll